how we make money is our own investments into these assets. And so, I personally have millions of dollars invested into these assets.
It's taken a long time to get to like where we are, and I'm sure where you are. Like for us, it was like proving that we had a track record of success. I'm going to be super selfish here shortly, and I know you will agree with me because I really want to ask about like the in-house management and the transition to doing we are obsessed with talking about that.
Oh man,
that's a whole nother thing. But I noticed on your website there's 3 partners, including yourself. So like, what are the 3 roles? What do you do, and what do your 2 partners do, and who are they?
Yeah. So my partners is Andy, who's my brother, and Coleman, who's our partner, who came on in about 2015. And so our technical titles in the company is CEO being myself, COO being my brother, and CFO is Coleman. I think a better way to describe that in a small organization like we have is I push the company forward through acquisitions and equity relationships. My brother cleans up the mess that creates with systems and processes. And then Coleman keeps track of all of it with the financial and analytics side of things. Now, in a smaller organization, we wear multiple hats. We help each other out. So it's not like it's hard lines on that, but that's a rough outline of how we divide our responsibilities within the organization. And as we grow, those lines get a little bit more defined. But, when we were talking back at 20, 30 units, they weren't defined at all. It was just like everybody jump in and do what you can to make this thing work. Did I answer your question?
Yeah, no, you did. And do you guys have like a central office that you all meet around a round table and discuss things, or like how does that look?
Yeah, we do. We have a corporate office, and it's pretty central within our portfolio. And the intention of buying it was less about, having a conference table for me to sit at with Andy and Coleman. It was more about being able to pull in our on-site team members for continuous education and interviewing and training and all the things like that. And so we picked a location that was pretty central within our portfolio. I talked about the beginning of our story and house hacking, that single family house with 6 bedrooms and renting it out. We did the same thing with the corporate office. So we bought a 12,000 square foot office building. We took the whole second floor for our space, but there was 4 leasable units downstairs, which we leased out, which, covered the expense of the building. And so we didn't want the overhead of a corporate office, but we said, this will help us scale and be more professional. And so we made that acquisition and helped with the cash flow issue by renting out the lower level units.
Yeah. Man, it's very, I mean, not to that scale, but very similar, our, I guess, methodology and coming up with, the studio that we're in now, we own the office building, and it's a shared office building. And we bought it with the intention that we need a place to have an office and do work, have clients come meet you at, but we don't want to pay rent, just like house hacking. So we're office hacking. We're basically leasing back to our own business when you think about it. And it's worked so far. It's definitely reduced a lot of expenses, but yeah, it's a lot of parallels. It's interesting. I love hearing what other people are doing, and it's like, kind of either justifies what you're doing, or you're like, I got to switch things up a bit.
I'm glad Jered just justified our office building
our
purchase.
Mad reasoning for doing whatever we do.
Yeah.
We have yet to figure out the management piece, so that's one piece that we're working on. So
yeah. So like what I was saying before, like we're always going back and forth between like, all right, look, here's property manager A. He's willing to do our entire portfolio for 8%. We're hands off. We don't have to worry about it. We pay him his monthly fee, and he pretty much takes care of everything. Or we do what you did. It's, build your own in-house team. You maybe hire an on-site person, a handyman sort of person. We're not at the scale that you're at currently, but do we bring all this in-house? Do we get rid of the property manager, stop paying him his 8%, and bring everything in and control it ourselves? So like, Jered, help us, at what point were you like, okay, it makes a lot of sense to form an in-house team? And so obviously not just for us selfishly, but like anybody else that's listening, when do you make that switch, and should you?
Yeah, no, I'm happy to tell you how we approached that. And that decision kind of came to a front around 20 units. So like single family houses, we had about 20 of them. And we said, either we're going to build a real company that will support the operations of the assets we own, or we're going to hire a third party management company. The decision made, which this was, I don't know, 15, 16 years ago now or whatever. We said, we're going to hire a third party management company because we want to focus on construction, right? Like we want to focus on renovating these things. And then once they're polished up, we'll hand them off to a manager. The approach we took in that decision was, I said, I don't want to go talk to the property management's sales team or their corporate staff that are going to tell me how good they are and why they're worthy of 8%. What I did was I found similar assets or similar rental units to the assets we owned in the market we were in, and I pursued them as if I was a prospective tenant. So I wanted to see how the property management companies were approaching customer service, their responsiveness, how were the sales people when touring the unit, how did they present the apartment when it was time to sell it. And I would say fortunately and unfortunately, fortunately for us, they did such a bad job that we ultimately never found a property management company that we were comfortable giving over what I see as the most important component of real estate investment, which is the operations. And so I can control the value of my property in multifamily, maybe a little bit more than say like single family. But if I increase the net operating income of my multifamily, the value of the property goes up. And so I want to be able to run extremely efficiently. So we didn't hire any third party management company. We dedicated our time and energy to building out what now is known as like one of the best property management companies in Cincinnati. So we don't do third party management. We only manage our own assets. But we've spent 15 years building the company that supports the operations that support our assets and therefore the financial returns. So we never went down that road. I can tell you from my years in the industry, at least in our market, that was a really good decision. Yeah. So like what I've watched other people do and how our operations can outperform, say, third-party management companies. I'm really glad we made that decision years ago.
Yeah.
Wow.
Yeah. No, it makes complete sense. And do you pay? So if you were, I don't know what property management goes for in your market, maybe 8% of gross rents. Is that about right? 8 to 10%?
No, in the larger assets, it's structured a little bit differently. Okay. So like, if you have a 100-unit apartment community, usually it's 3 to 4% of effective gross income. But at the same time, payroll is going to be a direct expense to the property. Where if you're talking about like the structure that you might be experiencing in single family homes, because you don't have that full-time person sitting in the leasing office or that maintenance technician that's assigned to that property, more than likely your 8% is including payroll, where in the larger assets, it's carved out. It's an additional expense to the fee. So 3 to 4%.
So when you're buying a 70, 80 unit complex, there oftentimes is on-site maintenance guys, on-site leasing agents, and et cetera. So when you're buying these properties, because you're self-managing them, I would assume you're inheriting a lot of those existing payroll personnel, right? Or are you putting in your own staff?
I don't think we've ever inherited them. So we're usually buying distressed. Well, that's our choice, right? So like, there are people who work there. They're not a fit for our organization most of the time because we're typically pursuing distressed assets, and that distress, as I said before, comes in either property management or construction, usually a combination of both. And so the standards that person or that employee has become accustomed to is exactly what we're trying to fix and change. And so we're not interested in, like, we just have a very high bar. And a lot of times the people that are working at the assets that we're buying can't meet that bar.
Yeah, no, that makes sense. I mean, it creates a lot more work because now you have to find someone, a replacement person, but I assume you're already working towards that before you even close on the property.
Yeah, I mean, at the scale we're at now, I mean, we have, full-time HR person that's like recruiting, and we're always looking for skilled people because we're growing, we're acquiring new assets, and at 50 employees, you have turnover. And so, yes, we're looking for the best in our market and our industry, and
Right.
we're constantly trying to recruit and pursue those people.
That's amazing. Wow, that's a whole operation. I mean, that's
So
crazy.
are you even underwriting your deals with management? Because if these people are just like on staff anyways, like are you like how does that look when you're running your numbers? I assume maybe you do include it still just to be conservative, but just wondering about that.
Yeah, so I mean, the underwriting process when I think everybody that does like larger multifamily, what they'll do is they'll have a line item on their income statement that says payroll, right? And maybe it's broken out into like office staff and maintenance staff. And so we'll anticipate, okay, how much does it cost us to hire a leasing agent? How much does it cost us to hire a property manager? How much for a maintenance tech? How much for a maintenance supervisor? All these roles will know what the going rate is or what we pay. We'll plug that into our underwriting. And then, as I said before, on top of that, we do charge a 3% management fee. So, in addition to the payroll cost, my company, SNS Management, is going to charge the asset a 3% management fee. For us, it's not the property management company is not a big money maker. Like when you say, well, what does that 3% go to? It goes to the HR person, it goes to the regional managers, it goes to the corporate accounting staff, it goes to the corporate office, all the back end that supports our property management company. That's what that 3% pays for. But we do have what happens is each asset is owned by an individual entity, and that entity hires our property management company, even though the ownership is very similar.
Got it. And for you and your two partners, because again, this is something that we discuss as well. How do you pay yourself? Obviously, you've got a ton of rents coming in, but you're also probably charging maybe acquisition fees on the syndication side. Like, what does that look like for you three?
Yeah, so going back to our core competency, I always say, and I think if you have any passive investors listening or even active investors that want to get into the syndication model, you ask yourself, what's your core competency? Ours is we are owner operators of multifamily assets. And secondarily, we use syndication to further that core competency. And the distinction would be like someone might be an expert at sales and marketing, raising capital. That's their core competency. And they just happen to use multifamily or real estate as the thing that they focus their capital raising competency on. But it could have been tech, it could have been whatever. And so the reason I say that is because I'm first and foremost the owner operator of multifamily, I'm heavily investing my own cash into our syndications. So I think the syndication world has gotten a reputation of like, you collect an acquisition fee, you don't put any of your money in. That's not how it goes. I mean, there's syndications where, we're putting in 50, 60% of the equity. And so a lot of skin in the game. So how we make money is on our syndications, we do charge a 1% acquisition fee. So that's like 1% of the purchase price. And then we charge a 1% asset management fee. That's not the big money maker for us. Really, how we make money is our own investments into these assets. And so, I personally have millions of dollars invested into these assets, and it's the operational cash flow that kicks off that because I own a percentage of them, I'm benefiting from those distributions. So I do not have a salary or anything like that. It's just whatever is left over at the end. I receive my portion based on my ownership percentage. And fortunately, we're in a market that produces very good cash flow. And we're also a very good operator to produce that consistent, predictable cash flow. So the majority of the money that I make is through distributions off of cash flow.
Can I ask a question? Because I'm genuinely curious. Is on a you don't have to tell me, but on let's say a 70 unit apartment complex in your market, mm-hmm. what cap rate is that? And what we're saying cash flow, what cash flow after all operating expenses, debt service, everything, what cash flow are we looking at? Monthly cash flow.
Yeah. So like cash on cash returns that we average is usually about 12. The cost per door, I think, was what kind of you're alluding to. Like, so typically we're, $100,000 per unit would be a fair average. Some more, some less. Did I miss anything, or is that all?
So your cash flow per door after everything.
Cash flow per door. It's not a metric we would track. So It would be return on investment. So like if you put in $100,000 into the investment, you can expect $12,000 per
Right.
year.
Yeah. Okay. That makes sense.
And then that's not including the exit. So,
Right.
once we exit the deal or once we refinance and return capital,
Because you're
what we've become known for, and it's the same story of we're good at buying an asset that has distress, forcing appreciation into it, and then stripping the equity through a debt restructure. So what we've done really well in the market conditions that the wind has been at our back. So um, we buy large assets, we force appreciation 2 to 3 years into the ownership. We do usually a supplemental loan or a full blown refinance. We'll return 100% of the capital back to the investors. The mathematical returns then become infinite. So in the example of if you were to invest $100,000 into our syndication, maybe you receive $12,000 in year one, $12,000 in year two. Year three, you receive $12,000 on cash flow, but also you get your 100 grand back because we took a new loan. Then in year four, you have all your money back, but you continue to own the same percentage. You keep getting that 12,000, assuming the debt service didn't eat away at it.
So your investors are getting high double-digit returns over the course of a 4 to 5 year investment.
Yeah, I mean, there's some of the deals that we bought back in 2015 and stuff where we're very fortunate that if you're calculating on a cash on cash return, because we've returned so much cash in the deal, the number's infinite.
Right. Yeah.
Right.
True.
So there is no cash in the deal, but it's still pumping out cash flow. So we've been fortunate to be able to do that on a lot of our apartment communities.
Nice. That's amazing.
And so we were wise to put all long-term fixed rate debt on all of our assets. And so now we're just kind of like, we can operate really well. We have steady debt structure, just, keeps pumping out cash flow while we, weather any recession that's on the horizon.
Sure.
For someone that's listening right now, would you agree with this, that everything that you're doing has revolved around one particular principle, which is like buying distressed, adding value, doing a cash out refi, pulling out the cash, and just snowballing and snowballing? Like, that's to say, like, if you had been buying turnkey, right, where you really did not get that opportunity to do a cash out refi, and you're kind of just maybe collecting rents and maybe just waiting for some appreciation, you would not have been able to snowball like you have been. Would you agree that for someone that's listening, if they want to get to where you are, they should probably adopt that same model?
I don't know if they should adopt the same model, but I would agree with that is what has allowed for our exponential growth. So, and it's because we have a skill set that we're very good at forcing appreciation. But, if you don't, maybe you just buy the asset that's more turnkey. It produces, let's say, 10, 12% cash on cash return. And if you can just slowly let that accumulate and then redeploy it, it's the same thing. It's just slower.
Right.
Yeah. But forced appreciation comes with a ton of effort. So that's my full-time job, is to force appreciation. So it's not a passive investment by any means. Our investors, it's passive because I'm the one, me and the 50 other team members are the ones doing all the work, but forcing appreciation equals effort. Right. And so I think if you're someone who has a full-time career and that's not what you're looking for, either you're going to invest with someone else like me, or that's not your strategy.
Right.
Yeah.
These investors that you have, I mean, I know Mike would agree with me. Like, we get asked all the time, it's like, oh, can you just recommend a private investor? I'm like, it's taken a long time to get to like where we are, and I'm sure where you are. Like, for us, it was like proving that we had a track record of success, right? Like, so, and that people that saw that were willing to invest with us. Is that the same place that you found your investors? Is that the same way that you found them?
For us, yes. So like, I'm not obviously we're on a podcast and this is really the only platform where I'll do like sales and marketing stuff. But the main component for us to get passive investors is word of mouth, right? So produce good results, and their networks will tell each other, right? Like, and we're really fortunate that we've been able to produce really great results. And so, looking back at, maybe to put this into context, our most recent acquisition was a 108 unit apartment community. We raised in equity, a little over $4 million for that. We raised that $4 million in less than 24 hours, and 95% of the investors were repeat investors. And so like, over years of performing, you just gain trust, you gain a few more connections through word of mouth. And it sounds easy, but I mean, there's years and years and years of repetition and showing up and doing what you said you were going to do, and sometimes more than that, and producing good results.
Yeah.
Wow.
That's amazing.
That is really amazing.
Thank you so much for listening to Sky's the Limit podcast. We're always releasing new content, so if there's something you want to hear, be sure to comment below. And don't forget, subscribe to our YouTube channel. And just remember, sky's the limit, dive deep, and invest in how you want to live.